What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently June 6th, 5:40 p.m. Eastern, Tuesday evening here in Canada. We're just going to be continuing from our previous market analysis and trade ideas webinar, but I just want to give some reminders and updates about my expectations of volume and volatility. I personally have very low expectations of volume and volatility. We're still early into the new business month. A lot of the prior major catalysts, such as jobs reports, Fed speakers, and anything of that nature has been priced in. We don't have really any high impact events this week to impact US dollar pairs, US equities, or gold. And we can see this as today we saw gold primarily ranging between key levels, some indecision on equities as we just ranged around 33,500 key level, and USD pairs ranging as well. The only reason I want to give this update and reminder is that we have to understand the importance of market volume and volatility and overall conditions to our trading. Many people come with the same expectations day in and day out, and this can really burn you and bring emotions into play if you do not adjust your mentality, risk, and execution to the changing market conditions. Remember, we do not set expectations for the market. The market sets expectations for us. All right. But other than that, before we jump into the analysis, we're just going to look at what data reports we have in focus, go through some market sentiment analysis, recap the events that have taken place so far, and then go through gold, dollar pairs like GU and Euro USD, USD CAD, GBPJPY, and US 30 stock market index for some trade ideas through the coming sessions. In terms of economic data in focus here, into the Asian session hours, we do have some GDP figures for Australia that's expected to show a decline. Now, Australia actually raised their rate instead of holding it by 25 basis points, which gave a short-term increased spike on AUD pairs such as AUD USD and AUD JPY, as they brought a surprise hawkish sentiment to the table. But that move has not been really further sustained, and we can easily see some pullbacks take place if this GDP data is off, feeding into the recessionary scare narrative. Overall, though, it was considered a surprise that they raised interest rates, and that is something the markets will be following as we understand how much weight and importance central banking monetary policy holds to these asset classes that we trade. Other than that, later into the Asian session, we have some imports and exports data yearly for China, as well as trade balance. Import and exports are both expected to see a pretty significant decline, feeding into that global recessionary scare narrative, showing economic activity decreasing, especially with international business there. This can still keep more demand in some safe haven asset classes short term, with the primary example we look at being gold. A lot of people have been asking me, gee, Japanese yen is a safe haven currency. How come with the bad data or any fear, yen hasn't really had any significant upside? Well, that's because, as we were reviewing in the last webinar, there is a fundamental catalyst, a level above any of the bad data, which is, of course, Bank of Japan's monetary policy. And the new governor, Ueda, has cemented their stance on keeping interest rates in the negative, their unlimited bond buying program going, and continuing to stimulate their economy, which, of course, devalues the Japanese yen in the currency. But we see how bullish the Japan stock market is due to the stimulus and support from the cartel of the currency, being the Bank of Japan in this situation. Then, London session is looking relatively quiet, as at 2 a.m. Eastern pre-London hours, We just have some industrial output monthly and yearly for Germany, expected to start to show some signs of rebounding from having very, very poor figures and negative integer territory. Now, don't get me wrong, from a macro perspective, Germany's manufacturing and industrial side is still in a recessionary scare range and still relatively poor data. It's very common to see the ebbs, waves, and flows of how data moves, and you're not just going to have continuous declining reports. You do get these rebounds. It's almost like a pullback we see in the market, but for data, right? Also at 2 a.m. Eastern, impacting GBP pairs, we have some house prices information monthly and yearly, expected to show some declines, which is, in my opinion, not going to hold that much weight, as obviously the Bank of England has been increasing interest rates and keeping rates elevated to combat and bring down increasing inflation. That's going to naturally result in house prices starting to cool down as you have less buyer demand in real estate due to increasing rates. Then 7 a.m. Eastern, some index reporting for CAD. That's not really too important. 8:30 a.m. Eastern, international trade balance for US won't hold that much weight. And then what's really important just for Canadian dollar sentiment is, of course, going to be Bank of Canada rate decision. They're expected to hold rates, but Canada inflation and CPI is still elevated. So we might see them follow suit with even what the Reserve Bank of Australia did and see a surprise 25 basis point increase, which would, of course, bring some short-term strength to the Canadian dollar, potentially also setting up with how we're seeing some exhaustion on the dollar, US dollar, to see USD CAD retest those deeper weekly demand zones we've been eyeing there. Other than that, in terms of economic data from Asian session to New York tomorrow, we are relatively quiet. We also have a Federal Reserve blackout period with markets in anticipation for Jerome Powell's testimony. Then after that, of course, the next FOMC is heavily in focus. Nothing besides the Bank of Canada rate decision going on in terms of a central banking and political perspective there. In terms of market sentiment, of course, on the higher time frame, we have been in a dollar bullish bias, understanding its status as the world reserve currency, and of course, as the Federal Reserve is still keeping interest rates elevated. But we must remain objective to both sides of the market. Just as we called those fantastic buys from 101 and called that rally, we are approaching an area of interest where we may see some resistance and potential secondary phases of market structure come into play, being pullbacks or consolidations. We're also on the intraday noticing that exhaustion digging up to this price point around 104.5 to 105. Don't be surprised if we see consolidations here or even some pullbacks, still setting up order flow for the new business month before we still continue more bullish on the dollar. When we're looking at dollar on the intraday time frames here, right? We don't want to get trapped in a situation like we saw with this bounce from 101 prior, where you can have beautiful respect to the demand zone we identified, very nice structure of buyers printing higher highs. But as you start to identify exhaustion and closures between these higher highs, where you're not printing anymore and you're starting to see some exhaustion signs, then it wouldn't be out of the ordinary to get some type of pullback and corrective phase as the markets move in waves. And of course, you have buyers liquidating positions, sellers jumping hand in hand to provide that exit relief. This, in our perspective of manual retail traders who watch these technical charts, printing a pullback or a secondary phase of market structure being a consolidation. So again, this upside rally we called on the dollar has been fantastic, but I can only see any more dollar strength if we can start trading and holding above 104.5 and especially above 105.5. Otherwise, if we don't break above these last key intraday highs, especially with some of the exhaustion we're seeing even during the day today, we can easily have some downward pullback moves that we would want to take advantage of that price change and price wave before jumping back into our higher time frame bias. Other than that, we're still seeing volatility index relatively flat, Japanese yen relatively flat, as yen has just been primarily dictated by Bank of Japan's loose and dovish monetary policy, as they're still continuing to stimulate and pump their markets, devaluing the yen. The only thing we have to be a bit cautious about is how we're sort of creating a bit of a double bottom here. So if we have any global fear, uncertainty, or doubt, bad economic data reports from other countries around the world outside of the US, as we don't really have much US data in focus since the PMI figures have passed, we can see short-term pullback phases, which is very common on GJ movement or any asset class movement, as you print these consecutive lower lows and you do not instantly break right away. So if I would see GJ break above 72, this would correlate, if I would see Japanese yen individually break above 72, this would correlate to GJ potentially having an extended pullback phase, setting up and retesting better lower demanded price points of interest. In the example here, if we don't see yen break back below 71, start to come back above 72 handle here and create a pullback phase, higher probability we can see GJ start to create a pretty significant pullback phase as well, which is very common in how it moves and trends. Overall, global equities still remain relatively flat. We have to understand market psychology and how strong greed really is. Even though we have the majority of these central banks still raising interest rates and keeping rates elevated, the crackheads with capital, we call them, don't want to let those gains go. But corrections in the stock market, no matter how unfavorable it is for politicians, corporations, and for the economy, are inevitable when the central bank's primary job is to be bringing down inflation back to a macro 2% goal. And we're still at macro elevated levels, 5 to 7% in most regions around the world. Outside of the Japanese stock market, which of course the Bank of Japan is on the flip side of monetary policy, still stimulating their economy, we can see the signs of exhaustion or just ranging and indecision on equity markets across the board here. The German DAX, the Australian Stock Exchange, Hang Seng in China has already been bearish, UK 100 still in bearish market there as well, below 7,700, and US 30 Dow Jones still respecting a very important liquidity zone around 34K flat there. Now, in terms of price recaps, nothing really to discuss here. We were still looking in the example of gold, of holding bullish macro structure as the base case for gold buys continues to grow, with global uncertainties on the rise, geopolitical tensions bubbling, and expectations of bad economic data. Beautiful bounce we called from the 1940s here and that demand zone, but we don't have our neck out of the woods just yet. To really see significant buyers into the market, we would need to be extending up to the 1980s and breaking higher. In terms of recapping events that took place today, we were really just ranging here. On Euro USD, we're still in overall macro bearish market structure as highlighted on the higher time frame, inverse of the US dollar, but we can't be ignorant to the exhaustion we're starting to see at these lows. Same thing on GBP USD. The same time we're seeing dollar as your world reserve currency holding a lot more weight in these pairs, rejecting 104.5 and 105 handle. Nothing to really recap in terms of the events that took place today. Canceled out the PMI move from yesterday, but did not continue trend, did not break any lower, just starting to range at these lows, still in a secondary phase of market structure outside the impulsive moves with trend, as we're just seeing a consolidation phase. Similar idea here on GU, UCAD being more of the inverse, but still ranging just between key level 3.4 and 3.46. Continued dollar weakness plus a surprise rate hike by the Bank of Canada to focus on combating inflation can easily drive us down to this important demand zone we want to retest around 1.33. Nothing really to recap on US 30. We called the sells from 33.8 in the previous market analysis webinar yesterday, which ran during yesterday's New York scalping session with bad PMI figures and more inflow into gold as a safe haven and outflow out of equities as a risk asset. But today, over the last sessions, we were just ranging here about 150 points from 33,500 key level up to about 33,600. Nothing to really recap. Majority of trade ideas are still looking pretty solid across the board. Now, when we're looking at gold here, in terms of trade ideas and analysis, I would love to see repetition of what we saw take place from the previous buyer jump, where we saw buy orders accumulated from that important demand zone. You can see we had this impulsive move, which started to top out around 1965, then started to get these multiple retests of 1953, an accumulation of order flow before starting to have trend breaking out higher induced by data. We're starting to see something similar take place as we had this double bottom and fantastic rejections at 1939 higher time frame key level, impulsive move due to bad PMI figures in factory orders the previous day, starting to get these bit of retests and indecision and looking for these extended upside moves. The only difference is we don't really have any US data in play, so we may see an increased probability that if we don't break above 1965, just to see some ranging occur here for a good majority of the week. Obviously, from a reactive standpoint, we still have to keep an eye out on headlines as geopolitical tensions are bubbling with military tensions between China and Taiwan, China in the US, and so forth. We can still see potential financial risks and cracks being exposed in the markets as more banking failures are expected in the near future in a higher inflation and higher interest rate environment. But we don't have any of those reactive events really in play holding market weight at the moment. And we don't really have any pre-planned events in focus. So my trade ideas on gold are still looking very standard and pretty much the same. If we were to retest 1953, 1958, or break above 1965, I would still primarily be looking for gold buys. I personally can only see any chance of gold sales either with a short-term pullback or exhaustion and rejection at 1980s, or my secondary bias would be very optimistic global data, way more demand in your risk assets, and gold would need to be breaking higher time frame bullish structure, as well as that very important liquidity zone at the 1940s. This is my main bias. This is my secondary bias. When we're looking at GBPJPY and understanding and backtesting its overall movement, you can see as consecutive higher highs are printed or you fail to break previous highs, getting these secondary phases of market structure, aka pullback, is extremely, extremely common. You see buyers liquidating positions, not having enough volume or reasoning to extend or pull in more demand further. Sellers jump in hand to provide that exit relief. This creates a pullback to retest better demanded lower price points. Continuations of the trend occur after that. Now, what we are seeing is signs of exhaustion roughly at 174, but also this bit of a minor support being held just around 173.2. If we do not print any new higher highs and we see Japanese yen individually starting to create more of a pullback phase from its lows, it wouldn't be out of the ordinary to get deeper pullback phases, even to roughly retest previous highs in this liquidity zone at 171 before really starting to continue more bullish here on GJ. Bringing that information together to the table, it gives us really clear-cut confirmations as we're seeing some indecision occur here. Where we can just have continuations of bullish structure and trend with Japanese yen weakness and buys from 173.8, 174, breaking above these rejection points here. And with correlation confirms of Japanese yen weakness, stronger UK data in terms of housing, break rejections, and intraday highs from the last price points roughly here. that gives you pretty clean targets to revisit these highs and continue trend. Otherwise, I am personally starting to see more signs of exhaustion and the increased probability that we can see these deeper downside pullback plays to retest better buy zones on the higher time frame, where I would see sells below 173.2, 173, and 172.8. This area marked out in blue, whether I'm a scalper or looking for day trades, would be a no trade zone, as we've had a lot of indecision, mixed price action, and no clear directional bias there. With our dollar pairs, of course, we're in overall bearish structure on GBP USD and Euro USD, but we have to understand how order flow can set up for the new business month and how the markets move in waves, and we can get some great confirmations in terms of market sentiment and intermarket correlations by looking at dollar index movement. Dollar being your world reserve currency and global business currency is why it takes precedent and holds most weight, and regardless of what trading pair it is involved in. In this instance, we can't be ignorant that even though we're bullish on dollar higher time frame, we are seeing clear-cut signs of exhaustion at 104.5, digging up to that 104.6 area. If we see dollar come back down to 103.9 and break lower, this is going to correlate to some bounces and pullbacks from Euro USD and GBP USD lows, where I'd be looking for the buys from key level and medium-term zone, both across the board. So here on Euro USD, I would still see these pullback buys with the dollar weakness to retest better liquidity zones of interest before sellers come back into the market. Or I would only see safe continuation sells in easy plays with breaks below these last lows. Here, pullback, dollar fails to break 104.5. So I would see 1, 2, 3 as buy areas to retest better sell zones of interest on the higher time frame, with expectations of a secondary phase of market structure on dollar taking place being a pullback if we cannot see dollar individually printing any new highs and starting to show exhaustion of buyers liquidating positions and sellers providing that exit relief, creating a potential deeper pullback and leg down to revisit those price points around 103.4 there. Similar type of idea on GBP USD. I don't really want to sell GU unless we have clean continuation trades, or what I prefer, to retest better sell zones of interest. Green box is obviously being sell zones. Green box is obviously being buy zones, driving price up to that red box area, which we identify as a higher time frame sell zone, better price positioning for us to get in. Otherwise, I would only see these continuation sells with market sentiment confirms of dollar printing some new highs, breaks below key level, and breaks above below these rejection points at 236. USD CAD overall is in bullish market structure correlated to dollar movement, but sees a lot more indecision with the impact crude oil has in terms of market sentiment to the Canadian dollar, as Canada's main export and revenue source is, of course, oil. Now you can see it's very common with USD CAD that you can identify these supply zones and rejection areas where you can get very aggressive waves, but the important thing is, an overall bullish market structure, you also still maintain the respect to these demand zones and see institutional orders collected there still extending and continuing trend. With a potential pullback on the dollar and short-term dollar weakness, as well as even expectations the Bank of Canada could do a surprise 25 basis point hike following suit with the Reserve Bank of Australia, we could see a move like this take place with a short-term downward squeeze into that demand zone 33325 before seeing buyers come back into the market. This is going to correlate and look like setups where I would take USD CAD sells below the range and key level here to retest those better buyer demand zones of interest on the higher time frame, as shown on the weekly there, giving us much better price positioning and entry areas. Otherwise, I would only see buys if Bank of Canada remains more on the dovish side, dollar breaks out into new highs, we break above this medium-term zone and price point where these rejections are at 346. Last but not least, US 30. Overall, even though we're seeing the greedy crackheads with capital still trying to hold on to gains as aggressively as possible, we cannot be ignorant to this very important price point, which held weight both during the stimulus phase when Feds were pumping the markets, and of course has held weight when the Feds shifted their monetary policy to start raising rates. It's a very important price around 34K, 34.3. Right? So as we fail to print any new higher highs and the Federal Reserve shifted their monetary policy, we started to create more bearish structure where this last low that was printed came from sell orders accumulated in that same important liquidity zone, which now becomes a very important sell side area for us, digging into 34K. If we cannot break above this 34K price point, I'm still looking for exhaustion and sells as macro inflation is still elevated and Feds need to keep interest rates up. Global economic data is on a steady decline. Recession scares are getting deeper and geopolitical tensions are still bubbling. This doesn't mean I'm expecting any market crash, but seeing a correction and slow, controlled correction is not out of the ordinary going back to these price points, but at 31,500, 32K there. Bringing that information to the intraday timeframes, we got further signs of exhaustion at this intraday zone and setting up price points for the new month around 33.8. If we can create a double top pattern, which just shows us from a technical perspective, not enough buyer volume to break higher and more sell orders being accumulated from those better price points, I would still be looking for sells from these areas. I'm not really confident in stock market buys as I see the stock market overvalued, just running purely on greed and hopes of a Fed pivot or hopes of more stimulus to come in, and just the crackheads with capital, not really seeing any significant rallies, just have seen a lot more indecision occur over the last couple of months in this general area from 32,500 up to 34,500. But yeah, keep in mind, still early into the new business month, lack of US economic data in focus, Federal Reserve blackout period. We're seeing lower volume and volatility with dollar pairs ranging, equities ranging, gold ranging. Stay adaptive to these conditions, but those are the trade ideas and analysis and price points where I would be looking for the confirms and what we teach in Capital Hungry in terms of day trades, or even if you want to scalp from those levels. I'm going to save and upload this, and then we'll also be doing a fresh Bitcoin analysis shortly and oil update probably tomorrow.